You know what nobody's talking about right now? The fact that every single 5G tower being built across America requires more silver than the entire 4G network used in a decade. And we're not building hundreds of these towers. We're building millions. Let me paint you a picture of what's happening right now, at this very moment, in the telecommunications industry. Verizon just announced they're accelerating their 5G rollout to 47 new cities by Q2 2026. AT&T countered with 52 cities. T-Mobile? They're going for broke with a nationwide expansion that requires 380,000 new cell sites. But here's what their press releases aren't telling you. Each one of those towers needs between 500 grams to 1.5 kilograms of silver. Not copper, not aluminum, silver. Why? Because 5G operates on millimeter wave frequencies that require materials with the highest electrical conductivity known to man, and silver is 7% more conductive than copper. At these frequencies, that 7% isn't a nice to have. It's the difference between a network that works and one that doesn't. I was talking to an engineer at Ericsson last month, one of the big three companies that actually manufactures this 5G equipment. He told me something that made my jaw drop. He said, "We're using 3.2 times more silver per unit than we did in 4G equipment, and we're producing units at 8 times the volume." Let that sink in. That's a 25-fold increase in silver demand from just one manufacturer. And there are only 3 major players in this space: Ericsson, Nokia, and Huawei. Now you might be thinking, okay, but how much silver are we really talking about here? Let me break down the numbers, because when you see them laid out, you'll understand why some of the smartest money in the world is quietly accumulating physical silver right now. The global 5G infrastructure build-out is projected to require 11 million new base stations by 2027. That's not my number. That's from the GSM Association, the trade body that represents mobile network operators worldwide. If we take the conservative estimate of 500 grams of silver per base station, we're looking at 5,500 metric tons of silver. Just for the base stations. That doesn't include the small cells, the distributed antenna systems, the fiber optic connections that use silver-coated components, or the millions of 5G-enabled devices that each contain silver. To put that in perspective, total global silver mine production in 2024 was 822 million ounces, or about 25,500 metric tons. So 5G infrastructure alone is consuming more than 20% of annual silver production. And we haven't even talked about solar panels yet, which consumed 140 million ounces last year, or electric vehicles, where each EV uses 25 to 50 grams of silver, compared to 15 to 28 grams in traditional vehicles. Or the medical industry, or water purification, or the thousands of other industrial applications that can't function without silver. Here's where it gets really interesting. Remember how I mentioned there are only 3 major manufacturers of 5G equipment? Well, there's a geopolitical chess game happening right now that's about to make this silver shortage exponentially worse. The United States government, along with most of Europe, has effectively banned Huawei equipment from their 5G networks. That means Ericsson and Nokia are now responsible for supplying equipment to markets that were previously split 3 ways. These 2 companies are running their factories at maximum capacity, and they still can't keep up with demand. I've seen the order backlogs. Nokia's current backlog extends 18 months. Ericsson's is at 16 months. And here's the kicker. Both companies are now competing for the same silver supply. They're not just competing with each other. They're competing with solar panel manufacturers who need silver for photovoltaic cells. They're competing with automotive companies who need silver for EV components and autonomous driving sensors. They're competing with defense contractors who need silver for missile guidance systems and radar equipment. Last week, I came across a procurement document from a major telecom equipment manufacturer. I can't tell you which one, but let's just say they're one of the big 2. This document showed they had secured silver supply contracts at $28.50 per ounce, locked in through 2025. The current spot price? $31.20. They're already underwater on their hedges, and they're locked into building equipment at prices they agreed to 18 months ago. What do you think happens when those contracts expire? They're going to have to go into the open market and compete for silver at whatever price they can get it. And when a company that needs 200 metric tons of silver per quarter suddenly shows up in the spot market, prices don't just rise, they explode. But let me tell you about something even more critical that's happening in the silver market right now. Something that most investors have no idea about. There's a phenomenon in the commodities world called backwardation. It's when the spot price of a commodity is higher than the future price. In normal markets, futures prices are higher than spot prices because of storage costs, insurance, and the time value of money. But when a market goes into backwardation, it means there's a shortage right now, today, and people are willing to pay a premium to get their hands on physical metal immediately, rather than wait for future delivery. Silver went into backwardation in March 2025. Not for a day or a week. It's been in backwardation for 8 consecutive months. That has happened exactly 3 times in the last 50 years. The first time was in 1979, right before silver hit $50 an ounce. The second time was in 2011, when silver went from $18 to $48 in 6 months. And now we're in the third episode. You know what else happened during those previous episodes? Industrial users started hoarding. When manufacturers realize there's a genuine shortage coming, they don't wait for prices to come down. They buy everything they can get their hands on, because running out of a critical input material is far more expensive than paying up for supply. I've been tracking import data from the U.S. Geological Survey, and something remarkable is happening. Industrial silver imports into the United States increased 47% year over year in the third quarter of 2025. But here's the strange part. Domestic industrial consumption only increased 12%. Where's the other 35% going? It's going into corporate stockpiles. Companies are building strategic reserves because they've done the math and they know what's coming. Now, let me connect some dots that Wall Street isn't connecting yet. China produces 3,600 metric tons of silver per year. That's about 14% of global production. But China is also the world's largest consumer of silver, using about 6,200 metric tons annually. They're a net importer of 2,600 metric tons every single year. And guess what China is building faster than any country on Earth? 5G infrastructure. They've already deployed 3.2 million 5G base stations, more than the rest of the world combined. And they're not slowing down. Their target is 5 million base stations by 2027. But here's where it gets geopolitically spicy. China has been stockpiling silver through the Shanghai Gold Exchange. We know this because of the withdrawal data. In 2024, total withdrawals from SGE silver vaults were 8,400 metric tons. That's 3.2 times higher than domestic industrial consumption. Where did that extra silver go? Into government reserves, into strategic stockpiles, into the vaults of Chinese institutions that understand what's about to happen. And it's not just China. India, the world's second largest silver consumer, imported 7,800 metric tons of silver in 2024, up 34% from the previous year. Mexico, the world's largest silver producer, exported 15% less silver in 2024 than in 2023, even though their mine production increased 3%. They're keeping more of their production at home. This is what a supply squeeze looks like in its early stages, before prices explode, before the mainstream media catches on, before your neighbor starts talking about it at barbecues. Let me tell you a story about what happened in the palladium market, because it's a perfect preview of what's about to happen with silver. In 2015, palladium was trading at $600 an ounce. It was primarily used in catalytic converters for gasoline vehicles. Then, 2 things happened simultaneously. First, diesel emissions scandals led to a shift back toward gasoline engines, which use more palladium. Second, stricter emissions standards meant each vehicle needed more palladium per catalytic converter. Industrial users thought it was a temporary spike. They thought new supply would come online. They thought recycling would fill the gap. They were wrong on all 3 counts. By 2019, palladium hit $1,600 an ounce. By early 2022, it peaked at $3,440 an ounce. That's a 473% increase in 7 years. But here's the critical detail. The palladium shortage was driven by one industry, automotive. The silver shortage is being driven by 5 major industries simultaneously: telecommunications, solar energy, automotive, electronics, and medical. The demand dynamics are exponentially more powerful. And unlike palladium, which had some substitution possibilities, silver has no substitute in most of its critical applications. You can't use copper in 5G equipment at millimeter wave frequencies. You can't use aluminum in photovoltaic cells. You can't use anything else in silver zinc batteries for medical devices. Silver is irreplaceable in these applications. Now, I want to talk about something that's relevant if you're thinking about your retirement security, because this silver shortage has implications that go way beyond just the price of silver. If you're sitting on $100,000 or more in retirement accounts, you might want to look into how precious metals IRAs work. I put together a free guide that covers how to get physical silver or gold into your retirement account without tax penalties. It's in the description below. Worth checking out if you're concerned about having all your retirement savings in paper assets during a period of industrial commodity shortages and monetary instability. Anyway, back to what's happening in the silver market right now. There's a concept in commodities trading called days of supply. It measures how many days of consumption the current inventory can support. For most commodities, a healthy market has 60 to 90 days of supply in inventory. When days of supply drops below 30, prices typically start rising sharply. When it drops below 15, you get price explosions. The COMEX, which is the primary exchange for silver futures in the United States, currently has 268 million ounces of silver in registered inventory. That's silver that's available for delivery against futures contracts. Sounds like a lot, right? But here's the context. Annual industrial demand for silver is approximately 550 million ounces. That means COMEX has about 178 days of supply. Except that's not quite accurate, because not all of that inventory is actually available. About 40% of registered inventory is already allocated to specific contracts or held by entities that aren't selling. So the real available inventory is closer to 160 million ounces, or about 106 days of supply. Still sounds okay, right? But watch what happens when we factor in the 5G build-out. If 5G infrastructure is going to consume an additional 177 million ounces over the next 2 years, that's 88.5 million ounces per year, or 7.4 million ounces per month. Suddenly, that 106 days of supply becomes 76 days. And that's before we account for increased solar demand, increased EV demand, or any investment demand. Now here's where it gets really interesting. There's a group of investors who figured this out. They're not buying silver futures. They're taking physical delivery. In the last 6 months, physical deliveries from COMEX have totaled 94 million ounces. That's 35% of total registered inventory, removed from the market in just 6 months. Who's taking delivery? We don't know all the names, but we know some of them. Sprott Physical Silver Trust has taken delivery of 18 million ounces. Several large family offices have taken delivery of quantities ranging from 500,000 to 2 million ounces each. And there are rumors, unconfirmed but persistent, that at least 2 sovereign wealth funds have taken delivery of significant quantities. These aren't speculators hoping to flip silver for a quick profit. These are sophisticated institutions with 20-year time horizons who've done the supply-demand analysis and concluded that physical silver is going to be one of the best-performing assets of the next decade. Let me show you what the supply side looks like, because this is where the story gets even more compelling. Global silver mine production peaked in 2016 at 900 million ounces. Since then, it's declined to 822 million ounces in 2024. That's a 9% decline over 8 years. Why? Because silver is primarily a byproduct of other mining operations. About 70% of silver comes from lead-zinc mines, copper mines, and gold mines. When those base metal prices are low, mines shut down, and silver production falls as a byproduct. But here's the problem. Even when base metal prices are high, it takes 7 to 10 years to bring a new mine online. You can't just flip a switch and produce more silver. You need to find deposits, get permits, build infrastructure, and ramp up production. The silver that will be produced in 2030 is coming from mines that are being developed right now, and there aren't enough of them. I've reviewed the pipeline of new silver mining projects. There are 23 major projects in development globally that could add approximately 85 million ounces of annual production by 2028. That sounds significant until you realize that industrial demand is growing by 40 to 50 million ounces per year. So even if every one of those projects comes online on schedule, which never happens, we're still looking at a growing supply deficit. And that's assuming current mines maintain production, which they're not. The average grade of silver ore has declined 35% over the last 20 years. Miners are having to process more ore to get the same amount of silver. That increases costs, which means marginal mines become uneconomic when silver prices are below $28 to $30 an ounce. Here's a specific example. The Peñasquito mine in Mexico, one of the world's largest silver producers, saw its silver production decline 18% in 2024 due to lower ore grades. The Cannington mine in Australia, another major producer, is expected to be depleted by 2028. The Greens Creek mine in Alaska is facing similar grade declines. We're not just facing a demand surge, we're facing a supply crunch at the same time. That's the recipe for a price explosion. Now let me tell you about something that happened in February 2025 that didn't get much attention in the mainstream media, but it should have. A major silver refinery in Switzerland, one of the largest in the world, announced it was operating at 97% capacity and had a backlog of orders extending 14 weeks. Normally, refineries operate at 70 to 80% capacity, and turnaround time is 2 to 3 weeks. This refinery was turning away new business because they literally couldn't process silver fast enough to meet demand. But here's the detail that caught my attention. They said 60% of their orders were for industrial applications, and 40% were for investment products. Historically, that ratio is reversed. Investment demand is usually 60 to 70% of refinery business. The fact that industrial demand is now dominating tells you everything you need to know about what's happening in the real economy. Companies are scrambling to secure silver supply. They're not waiting for prices to come down. They're not hoping the shortage will resolve itself. They're buying now, at current prices, because they've calculated that the cost of not having silver is far higher than the cost of paying up for it. And this brings me to the most important point I want to make today. The silver market is tiny compared to other commodity markets. The total value of all the silver in the world, including jewelry, industrial stockpiles, and investment holdings, is approximately $1.4 trillion. That sounds like a lot until you compare it to gold, which is $15 trillion, or the global bond market, which is $130 trillion. What happens when a tiny market faces a massive demand surge? Prices don't rise linearly, they rise exponentially, because there's not enough supply to meet demand at any reasonable price. The market has to ration supply through price, and the only way to ration supply is to push prices high enough that marginal demand gets priced out. Let me give you a historical example of what this looks like. In 1979, silver was trading at $6 an ounce. The Hunt brothers, a wealthy Texas family, started accumulating silver because they believed inflation was going to destroy the dollar. They bought futures contracts, took physical delivery, and kept buying. By January 1980, silver hit $50 an ounce. That's a 733% increase in 12 months. Now, I'm not suggesting silver is going to $50 in the next year, but I am suggesting that the fundamental supply-demand dynamics we're facing now are more powerful than what the Hunt brothers created through financial speculation. This is real industrial demand. This is structural shortage. This is not going away. And here's something most people don't know about that 1980 silver spike. It wasn't just the Hunt brothers. Industrial users were hoarding. Jewelry manufacturers were stockpiling. Investors were panicking. The Hunt brothers lit the match, but the fuel was already there. Today, we don't need a Hunt brothers to light the match. The 5G build-out is lighting it. Solar energy is lighting it. Electric vehicles are lighting it. The match is already lit. We're just waiting for the fuel to ignite. Let me show you what some of the smartest investors in the world are doing right now. Warren Buffett, who famously avoids commodities, held a massive silver position in the late 1990s. He bought 129.7 million ounces of silver between 1997 and 1998. He held it for several years, then sold it around $7 to $8 an ounce. He later said selling that silver was one of his biggest mistakes. Silver went on to hit $48 in 2011. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has been vocal about the need to own hard assets during periods of monetary instability. His fund has positions in precious metals, including silver, as a hedge against what he calls the devaluation of money. Stanley Druckenmiller, one of the most successful hedge fund managers in history, recently said in an interview that he's concerned about the supply-demand dynamics in industrial metals, particularly those critical to the energy transition. He didn't name silver specifically, but if you look at his fund's holdings, They've increased their exposure to silver mining companies by 340% in the last 18 months. These aren't gold bugs or conspiracy theorists. These are rational, data-driven investors who've built their careers on identifying asymmetric opportunities. And they're positioning for a silver shortage. Now, let me address the elephant in the room. Some people will say, but what about recycling? Can't we just recycle silver to meet demand? Yes, silver is recyclable. About 180 million ounces of silver are recycled annually. But here's the problem. Most silver in industrial applications is used in such small quantities that it's not economically viable to recover it. The silver in a 5G circuit board might be worth $2. The cost to recover it is $8. It doesn't make economic sense until silver prices are much, much higher. The silver that gets recycled is primarily from jewelry, silverware, and old photography film. But jewelry demand has been declining for years as silver prices have risen, and photography film is basically extinct. So the sources of recyclable silver are shrinking, not growing. Even if recycling rates doubled, which would require silver prices above $50 an ounce to make it economical, we'd only add 180 million ounces to annual supply. That doesn't come close to closing the supply-demand gap we're facing. Let me paint you a picture of what I think is going to happen over the next 24 to 36 months. Phase 1 is already underway. Industrial users are building strategic stockpiles. Refineries are operating at maximum capacity. COMEX inventories are declining. Prices are grinding higher, but the mainstream hasn't noticed yet. We're in this phase right now. Phase 2 will begin when a major industrial user announces they're having trouble securing silver supply. Maybe it's a telecom equipment manufacturer. Maybe it's a solar panel company. But someone is going to publicly acknowledge that silver shortage is impacting their operations. When that happens, every other industrial user is going to panic and try to secure supply simultaneously. Prices will spike. Phase 3 is when investment demand kicks in. Right now, most investors aren't paying attention to silver, but when they see prices rising 20, 30, 40% in a matter of months, they're going to want exposure. ETFs will see massive inflows. Retail investors will start buying physical silver. That investment demand will compound the industrial shortage and push prices even higher. Phase 4 is when governments get involved. When a critical industrial metal is in shortage, governments start implementing export controls, strategic reserves, and supply allocation systems. That happened with rare earth elements. It happened with lithium. It will happen with silver. And when it does, prices will go parabolic. I can't tell you exactly when each phase will occur, but I can tell you that the setup is more compelling than anything I've seen in the commodities market in 15 years. Here's what you need to understand. This isn't about speculation. This isn't about trying to time the market perfectly. This is about recognizing a fundamental supply-demand imbalance that's going to take years to resolve, if it can be resolved at all. The 5G build-out isn't optional. It's happening. The solar energy transition isn't optional. It's happening. The electrification of vehicles isn't optional. It's happening. And all of these trends require silver, not copper, not aluminum, silver. And the supply isn't there. It's not in the ground waiting to be mined. It's not in recycling streams waiting to be recovered. It's not in government stockpiles waiting to be released. The supply deficit is real, it's structural, and it's growing. So what does this mean for you? It means that silver, which most investors ignore because it's not as sexy as Bitcoin or tech stocks, might be one of the most asymmetric opportunities available right now. It means that the industrial metal that's trading at $31 an ounce today could be trading at multiples of that price in the not-too-distant future. It means that the companies building 5G networks, the companies manufacturing solar panels, the companies producing electric vehicles, they're all going to be competing for the same limited silver supply. And when supply is limited and demand is surging, prices don't rise gradually. They explode. The silver shortage in 5G technology isn't coming. It's here. It's happening right now. The question isn't whether prices are going to rise. The question is whether you're going to position yourself before the rest of the world figures out what's happening. Because once Phase 2 begins, once that first major company announces supply problems, it's going to be too late to get in at reasonable prices. The smart money is positioning now. The question is, are you?